No, now it's going to live, sir.
Yes, sir. Time agla illa, mother.
Around 4:54, sir.
Adan solren. 5 o'clock thane unga program.
Yeah.
You can wait, na.
Around 4:50 or 4:55.
Okay.
So shall we start the introduction, sir?
No, 4 minutes irkema.
Okay.
Online meeting, please. Close the door. Like it should not be a complaint, but you started before 5, na. We'll sharp 5 start panila. Another 3 minutes is it. Okay, we'll wait.
Okay, sir. Okay.
Madan ஆரம்பிச்சிடலாமா?
Sir, ஆரம்பிக்கலாம் sir. Yes, sir. Yes, sir.
Respected Chairman, C.A. Chinnamasan Thalakaila, respected Secretary, Naresh Chandra Gilli of SIRC, respected Speaker of the Day, C.A. Badri Narayanan K, and the respected participants of this program, Namaskaram to all of you. We all know that SIRC is organizing a continuous virtual CPE program almost every day in this time. And this has been a practice for most of the members nowadays to attend this program. So we are happy that the members are preferring this. And the same way, SIRC is continuously making the effort to implement this program. And today's program being on standards on auditing relevant to small practitioners. And the speaker of the day is Mr. Badri Narayanan, C.A. Badri Narayanan, sir. And relevance of auditing and for the small practitioners, I think it's a very vital topic. Especially, I can tell you, for the people who are living in cities like Coimbatore and Chennai and Bangalore, any area of our region, big area, Hyderabad, everyone, because we have a lot of small practitioners in these areas. Like I think Badri Narayanan sir will also agree. If you say Coimbatore, it has been surrounded by 4 branches: Salem, Erode, Tripur, and Coimbatore. All are nearby only, and there are a lot of small practitioners, and we have big number of chartered accountants in that area. The same way we have in Chennai, we have a lot of small practitioners, definitely. And the standards, what is applicable, has to be updated as per our thing. And therefore, this program has been conducted, and it is much useful because small practitioners may commit a small mistake. But this is what we also conducted in our CPE programs on ethics, where we have said that we may make a small mistake which will lead to big issues for the small practitioners. So I congratulate our own SIRC for this, for conducting this type of program, and I happily welcome the participants of the day. And Sri Badri Narayanan sir, K. Badri Narayanan, his qualification is BSc, FCA, grade CWA, ACS, and a registered valuer in securities and financial assets. He is a practicing chartered accountant since 1990. நானும் அதே வருஷம் தான் சார் ப்ராக்டிஸ் ஆரம்பிச்சேன். Thank you. And is a partner in his Badri and Vijay CA and Coimbatore, and specialized in the areas of accounting and accounting standards and finance. A faculty in the seminars and meetings organized by SIRC of ICI, Southern branches of Institute of CA and ICWA, ACS, and CII Coimbatore. Has been addressing commerce and MBA students and faculty members in colleges and universities on various topics, including accounting standards and Companies Act, finance. Was a faculty in Coimbatore branch of ICI for CA students and CS Institute Coimbatore at all levels in the subject of this accounting and financial management. Was a chairman of the Coimbatore branch of CA in of ICI in 1999. Committee member of Auditors Association of Southern India. Has authorized a book on inventory valuation published by ICI Coimbatore. And has got a wife, blessed with 2 daughters. Elder is also a practicing chartered accountant, and younger is an engineer. This is the introduction of C.A. Badri Narayanan sir. Thank you, sir, for giving your concern to this topic and the program. Welcome, sir. Thank you. The forum is yours, sir. Thank you. Sir, mute எடுத்துருங்க. Yes, sir.
Chairman and other office bearers of SIRC. Thanks to Sri Sundarajan sir for having introduced me and the topic. I think I've seen him very early, along with Rajan sir in Coimbatore, where there was some seminar held on ethics or something like that. Nice meeting you, sir. The topic that has been taken today is standards on auditing relevant to small practitioners. Nowhere in the standards or ethics there is a definition for small practitioners, but nevertheless, I have my own understanding of small practitioners. Most of them are involved in income tax practice or maybe GST practice, but nevertheless, they do some audits here and there, some certifications here and there, some reporting is done. For banks, they certify the financials of a sole proprietor concern or a partnership concern and all that. Therefore, even though they are largely involved in tax practice, they might be doing, for some reason or the other, the audit practice also, side by side possibly. But nevertheless, as you pick an audit and start looking at the certification of financial statements, perhaps it is better we get into the standards that the practitioners are required to follow. If not all these standards, some important standards, audit standards, are going to impact the small practitioners also. So I thought I must have to brief the standards that will largely apply to small practitioners. In fact, last year also I took a seminar on the same topic when last year or year before last year, I'm not sure, when Dungar Chand Jain was the chairman, where I told him that I will do something on standards relating to small practitioners. At that point of time, he asked me, what does a small practitioner really mean? I have some understanding on small practitioners, sir. Therefore, it is my understanding only. There is no specific definition, even though the MSME Act defines a small enterprise, be it a manufacturing company or a service company. So with this in mind, let me proceed and take you to a detailed understanding of standards on auditing relevant to small practitioners. The agenda that has been picked up by me is to understand who are small practitioners, the list of engagement and quality control standards that are in existence today. Probably we largely group it under the term standards on auditing, SAs, what we call as SAs. But there is standards on auditing, there is standards on assurance engagements, there is standards on related services. So various other standards are there, but everything put together, let us call it as standards on auditing, which is the popular way of calling it. There are certain standards on auditing which may not really impact the small practitioners, and I'm not going to very detailed discussion, do any detailed discussion on these standards. I'll brief up the other standards which may have an impact on the small practitioner. Then the Quality Review Board of ICAI has made some observations on audit quality as to all practitioners, which also I will brief you up and leave it to the audience finally for discussion, which will mutually benefit the chartered accountants assembled here, including me. Now, who is a small practitioner? There are definitions available legally under MSME Act, or a small company definition is there in Companies Act, or maybe a small and medium-sized company, SMC, under the Companies Act. Under MSME definition, there are two thresholds, one for plant and machinery investment, the other for turnover of a particular entity. Now, this definition as to MSME, micro, small and medium enterprises, applies to both manufacturing and service enterprises. A micro enterprise is an enterprise which has invested in plant and machinery up to 1 crore. Annual turnover up to 5 crores, both cumulatively. Plant and machinery investment should not exceed 1 crore. Turnover should not exceed 5 crore. If these thresholds are met, it's a micro enterprise, be it manufacturing or service industry. As practitioners, as chartered accountants, as professionals, we will come under the category of services rendering enterprises, and therefore a plant and machinery or office equipments and all that, it could be something like 1 crore, which is not that very big for today's enterprises. The turnover is 5 crores, substantial, but yet you will be a micro enterprise if your turnover is up to 5 crores. Then small, it is up to 10 crores of investment in plant and machinery and 50 crores of turnover. And medium, it is 50 crores of investment in plant and machinery and 250 crores of investment, 250 crores of annual turnover. So this is the definition of micro, small and medium enterprises. Of course, when we call somebody a small practitioner for the matter, it may not include micro, but let us largely understand that micro, small and medium put together could be small. At least micro and small are small. So a chartered accountant who is having an annual turnover of 50 crores will be small if you look at this definition, but I won't go with this definition just for the sake of understanding or just for the sake of academics. I picked up this definition. So a chartered accountant whose revenue is up to 50 crores would be a micro or a small enterprise or a small chartered accountant. The thresholds of plant and machinery is based on the income tax return file. The turnover does not include exports. Turnover as per the ITR will be taken. The term we popularly understand something called SME. SME excludes micro enterprises. Again, technically, the term small and medium enterprises, what we popularly shorten it up as SME, excludes micro enterprises. MSME is micro, small, medium enterprises. SME is small and medium enterprises. This is the definition under MSME. If you look into this definition, a small practitioners will fit in into the threshold of 50 crores of turnover. Let us leave this plant machinery for some time to come. But if your revenue is less than 50 crores or up to 50 crores, you will be a small practitioner. But practically looking at it, we may not be understanding this way. As a small practitioner, a practitioner's income of up to say 50 lakhs or 1 crore or 2 crores could be a small practitioner. Then there is also definition of small and medium sized company under the Accounting Standards Rules 2021. Here also the thresholds are the same as that of earlier. It was different. After the advent of the new definition under MSME, this SMC definition at Accounting Standards Rules 2021 has also been amended to understand that up to 250 crores, a company will be a small and medium sized company up to 250 crores of turnover. Companies whose equity or debt are not listed in stock exchanges, not a bank, not an insurance company, not a financial institution. Turnover threshold is up to 50 crores in the immediately preceding accounting year. Borrowings up to 50 crores in the immediately preceding accounting year at any time. It should not be any holding company or a subsidiary company, will not be a SMC, it will be a non-SMC. Then all the above conditions need to be satisfied together at the end of the relevant accounting period. So if there is a holding company where there is a subsidiary existing, then it will not fit into the definition despite the thresholds have been, despite the fact that the thresholds have been met. And again, if you are a subsidiary company, you will not come into the definition of small and medium sized company. Of course, practicing chartered accountant to a large extent are not corporates, and therefore this may not be very relevant, but a small practitioner might be doing the audit of a small and medium sized company, and therefore I thought I should bring in this definition also to understand what a small and medium sized company under the Companies Act looks like. Then there is also a definition of small company under section 285 of Companies Act, which has been recently amended effective from 15/9/22, where if a company's paid up capital does not exceed 4 crores and the turnover cumulative again, and the turnover does not exceed 40 crores, then the company will be a small company. There are certain exemptions available under the Companies Act for the small company. The turnover as per section 291 is revenue. There were some confusions earlier. Prior to 2017, the turnover was defined as realization from the customers of the company. Now that that aberration has been changed. It is revenue now. Put simply, the turnover. The turnover and the share capital thresholds are to be cumulatively met. Then it is a small company. Therefore, there is a definition of SME which could impact the chartered accountants. There are also definitions for small company here and SMC, small and medium sized company under the accounting standards rule. These will have some relevance overall to understand where exactly a chartered accountant will fit in. How exactly we understand a particular CA as a small practitioner. Nevertheless, a small practitioner, as I put in the beginning, as I briefed in the beginning, is somebody who is doing more of income tax practice and less of audit practices. Just to brief you as to how many standards are there, what we call as engagement and quality control standards, together could be taken as standards on auditing. There is standards on quality control, what we call as SQC. There is standards on audit. There is standards on assurance engagements. SA and SAE are almost the same. There is standards on review engagements, SRE, and there are standards on related services. All these combined together could be as simple as standards on audit. For the sake of convenience, even though standards on audit may not include standards on related services, which is not really audit, or standards on review engagements, which is not a comprehensive audit. The standard on quality control is one SQC one, which is applicable to all practitioners relating to all engagements, which means this standard will straight away apply to small practitioners also. This standard on quality control is to ensure that the concerned firm of chartered accountants, the term firm has been defined to include sole practitioners also, even though normally we understand firm as something which is not a sole practitioner sort of an organization. A sole practitioner CA is also understood as a firm under the standards on auditing. Therefore, this SQC1 is applied to all practitioners or all firms relating to all engagements. It could be a audit engagement, or it could be a review engagement, or it could be an assurance engagement, or a related services. It applies to all engagements across the board. So please remember, as a small practitioner, as a practitioner per se, you would be impacted with standards on quality control, which I will brief up soon after understanding the various standards in summary. There are assurance engagements, what we call as essays, where we give an opinion. There are some standards which are very specific, like SAE, standards on assurance engagement, as to prospective financial information, which is projected P&L, balance sheet, or projected financials as a whole. There is a standard as to how exactly we go about when we ask to certify or give a report on projections. These are all assurance engagements. Then there are review engagements, which is more of a limited assurance, what we call as SRE. These are all assurance engagements. Then related services, these are all not assurance engagement. Something that are related to the financials. where we give some sort of report, but that is not an assurance, about which also we will discuss later. To understand how many standards are there in each of these category, SQC1, only one standard is there on quality control. Quality control that has to be maintained by the practitioners in their office. One standard. Then the standards on audit are bifurcated into categories like this. General principles and responsibilities as to audit, 9 standards on audits. Risk assessment and response to risk, there are 6 standards. The risk assessment and response to risk is very important because based on risk, we define the scope of auditing. If there is more risk, the scope has to be more. If there is lesser risk, the scope will be slightly lesser than what you do for a more risk audit assignments. So for risk assessment should precede the audit. And there are 6 standards on audit relating to risk assessment and how do you respond to the risk that you have identified. In audit evidence, there are 11 standards on audit. Most of the time we have to use the work of others. Like for example, we may be going through the gratuity provision based on an actuary report. Of course, we don't use the actuary, but we use the report of the actuary. How exactly we have to go about? All those are explained in the standards. We may seek the help of other auditors as to a particular matter. We may be falling upon the internal auditor's report for giving an opinion, or we may be taking the advice of an expert for impairment of reserves or whatever. All these sort of a dependency on other persons other than the concerned engagement that you concerned person who is taking up the engagement is using the work of others. There are 3 standards on audit regarding that. Then audit conclusions and reporting, which is the final end of the audit where you give a report or a certificate or whatever. There are 6 standards. There are specialized area standards where financial statements prepared under special purpose framework, etc. Now, most of the financials, the P&L and balance sheet that we prepare is general purpose financial framework based on the regular accounting standards. The regular accounting standards, what we call as AS, or the India AS based accounting standards. These are all general purpose financial framework, which is the normal sort of an accounting across the board for all entities. There are certain special purpose framework. Possibly, I would put it like this. For insurance companies, there could be some way of accounting for premiums received and all that, or making risk reserve and all that. Then for banking companies, the NPA provisions are slightly different than what we normally understand for bad debt provision. Therefore, some statements are prepared under special purpose framework where the framework for preparation of financial statements will be slightly different than what you otherwise have under the framework for preparation of financial statements, which precedes the accounting standards. There are 3 standards on audit which discusses about this. Then there is some sort of review engagement. In a normal assurance engagement like a company audit or a tax audit or whatever, we give a reasonable assurance. In a review engagement, it is more of a limited assurance. I will explain what exactly is limited assurance later. There are 2 standards on review engagements. Then assurance engagements other than audits or review of historical financial information. Popularly, there are 3 standards, but we will be more concentrating on assurance of prospective financials. Quite often we get into or we involve ourselves into the projection of financials for the clients, either helping them out how to exactly go about, or maybe certifying the financials. There are certain issues involved, and most of us might be aware of that also. Especially small practitioners do this quite frequently. Let us discuss the standards relating to these sort of engagements. Then standards on related services like compilation. Compilation is just the data compilation. Maybe sort of a presentation and disclosure requirements are also seen. For example, mostly bankers require, before the actual audited financial statements are submitted to the bank, they want some provisional balance sheets and provisional profit loss account or provisional financials. There, it is better the small practitioners do not sign the provisional financials, but compilation report possibly could be given. How exactly to go about in giving a compilation report? There are 2 standards over there, which also we will discuss. So taking all this into account, the total number of standards, including the standards on quality control, numbers to 46 standards. There are 46 standards, which includes only 1 standards on quality control. Of course, beyond all these standards, there are guidance notes, implementation guides. There is also ebook on checklist for audit standards. One such important guidance note is guidance note on reports or certificates for special purposes, revised 2016. Now, this is not included in that 46. This is more of a guidance note. But this guidance note is very important to understand. Very frequently, we give some reports, which may not be an audit report, or certificates which are more often given, pollution control board certificates or fixed asset certificates, or maybe turnover certificate, net worth certificate. There are a lot of certificates we give. Even though we give certificates, we can't call it as even reasonable assurance or limited assurance. We possibly tend to give an absolute certificate stating that the fixed assets are worth this much, or the book value of fixed assets is this much, or the turnover is this much, or the net worth is this much. The institute has prescribed that there can't be a zero risk in an audit. There has to be some risk. You have to have management responsibility informed through your report on certificates. You should also inform your responsibilities in the report and give a sort of a reasonable assurance only and not absolute assurance, even though most of the times you are asked to frame a report stating that the information is true and correct. Even though you give true and correct, you must append this format that is specified in the guidance note to ensure that the risk is properly covered. So all these standards and these guidance notes are given to mitigate the problems that you will face later based on the report that you have given. So we must understand, to the extent, is it easier to follow all these standards in a office where the small practitioner himself has to do so many work. The staff infrastructure in the office will be very low. The practitioner has to do everything. Is it possible to follow all these standards on audit, guidance notes, implementation guides in letter and spirit? Is always a question. But are we trying to follow? Are we aware of the various standards? Do we get into some sort of a quality control that could be maintained in the auditor's office is always a question. So my aim is to advise all of you to ensure that you read these standards, understand these standards, follow to the extent possible. Largely, this will mitigate your risk. This will mitigate your risk. The entire understanding is to ensure that audit risk is minimum. So you take all care and do the audit. These standards will help you to achieve that goal. There are a lot of literatures available in our website ica.org, and there are also publications available in kbknowledgebank.ica.org. These 2 sites will help you to get all the documents, the standards, the guidance note, the implementation guides, the ebook. Everything is available over there on touch of a button. You can download it freely and get to know what is there in all those literature. Some standards which may not really impact the small practitioners I have taken. SA 299, joint audit of financial statements. As for a small practitioner, there may not be joint audit at all, or maybe 1 or 2 may be there, but I will deem that joint audit of financial statements may not happen in a small practitioner environment. Then using the work of another auditor, that may not also be there. Communication of CAM, the key audit matters, this is as of now applicable to only listed entities. Even though there are key audit matters that will arise in any audit, the communication need not take place in the audit report. Therefore, these standards may not impact in a larger way the small practitioners. Obviously, it is inapplicable for unlisted entities. It is applicable only for listed entities, unlisted companies, partnership firms, all that is out of this standard. Then there is also a report on interim financial information that you give, possibly for listed companies, that may not impact small practitioner. Then the assurance engagement relating to pro forma information in prospectus. Prospectus is normally prepared when there is a public issue. Therefore, this standard may not also impact small practitioners. Joint audit using the work of another auditor, CAM communication, interim financial information reports, and assurance engagements relating to prospectus. All these standards may not impact the small practitioner. This is one standard which normally is not read by chartered accountant, but it is a wonderful piece of literature which advises you how to exactly go about in running your audit office. The standards, this standard is to ensure that quality control is maintained. After all, quality is prime in engagement. Your engagement culminates into a report or a certificate, and it has to be of high quality. So to ensure quality in the final report or in the final certificate that you provide to the client or the user, there has to be some quality control measures that has to be undertaken by the concerned firm. So this standard helps small practitioners to maintain quality in the processes that will result in preparation of report or preparation of certificate. It applies to all engagements of all audit firms, be it a proprietorship or a partnership or an LLP, irrespective of their size. So it is across the board applicable to all audit firms. The quality control measures will provide assurance as to ethics, standards, legal and regulatory requirements. So ethics is more subjective. Of course, we have code of ethics for ourselves. Then standards are reasonably objective. Legal and regulatory requirements are very straight, which we have to follow. For example, an auditor under the Companies Act have to rigorously follow the provisions of Companies Act relating to audit without any dilution. And therefore, all the recommendations or guidance given in the quality control standard is to ensure compliance with ethics, compliance with standards, compliance with legal and regulatory requirements. The quality control standard talks about broadly the leadership responsibilities. For any auditor office, there has to be a leader. For any organization, there has to be a leader for that matter, who is to lead by developing the policies and procedures to promote the internal culture. He has to conduct training, seminars and meetings for the staff of the firm. He has to get into formal or informal dialogues with the staff. Possibly there could be a newsletter that can be circulated once in a month. All that is leadership responsibility. Normally, the leader of or the chief of an audit firm would be a managing partner, or for a bigger firm, it could be CEO sort of a person. So they have to ensure that proper policies and procedures are established so that the quality is maintained. After having done audits for a client, continuance of client relationship. Just because we have done audit for a client in the earlier year and it has gone smoothly, we can't presume that this year also it will be smooth. Therefore, whether to continue the engagement, whether the risk has increased and all that, that has to be ensured. There are certain guidances given in the standards. Then in any organization, the human resources are very important, and it is one of the major assets of an organization. Therefore, you have to have good human resource policies for recruitment, for performance evaluation, for determining the capabilities of the staff, for to develop their competence, their career development, promotion, compensation, and beyond all, before taking up an assignment, you must estimate the personal needs. If the staff requirements for staff available in the firm is very less, and if you can't do the work or justify the work with the present staff level, either you have to increase the staff level and put in some more competent staff, or not take the assignment. All these are under the human resource guidance given in the standard. Then the engagement performance, how the engagement is being carried on. In fact, there is a quality control review that has to be done parallelly with engagement, and unless the quality control review is done fully, the engagement cannot get completed. The signing off of the report or the certificate should be after the quality control review is over. Therefore, it is sort of a process audit where you, as the engagement is carried on by the engagement partner and the team, there has to be some outsider or an insider partner to ensure quality review periodically as the work progresses. And once the quality review is over, then the report signing off can take place. The monitoring, in fact, is after the report is given. After everything is done, you must monitor and see whether there is a drop in quality which has to be improved. Therefore, engagement performance is, as you undertake the engagement, there has to be a review by a person who is not the engagement partner, who is not in the engagement team. And monitoring is something that happens after the engagement is over to ensure that any mistakes that has already been done gets corrected. Leadership responsibilities, I have already explained this. The sole proprietor or the managing partner or some other CEO sort of a person should take overall responsibility for quality control. Operational responsibility can be delegated to an appropriate person. Firm and personnel should comply with ethical requirements, integrity, objectivity, competence and care, professional behavior, and independence. Independence is some sort of a scenario where the person involved in the audit, both engagement partner and his team, should be independent of the concerned client. In fact, there is an annual letter that you have to take from the engagement partner, from the firm and the firm's personnel, stating that they are independent of the concerned client. These are all the ethical requirements. Communication of quality control policies and procedures to all personnel, very routine. Engagements are accepted and continued without compromising client integrity, competence of the firm to complete the engagement, and feasibility to comply with ethical requirements. Human resources I have already explained. Human resources policies are to be required to be established. HR policies relate to estimation of personal needs, recruitment, training, performance evaluation, and compensation. The firm should identify an engagement partner and assign appropriate staff for each engagement. These are all something that we already know. But as we read this in a standard, we get confirmed as to what we know, and we get some more guidance as to exactly how we have to proceed in ensuring the quality control. So primarily, as you read, you will believe that all of this we know. That could be the understanding. But nevertheless, as you read again and again, you will get some more information, additional information, by which your office decorum will grow, your office quality will improve. Engagement performance, competent quality control reviewer to be appointed, can be internal or external. I did tell you this earlier. There has to be a quality control review that has to take place. This is not very compulsory. Quality control review as the work progresses. There has to be a quality control review. That quality control reviewer can be an internal person or an external person, but he can't be the engagement partner. He can't be a person involved in the engagement. He cannot be in the engagement team. He has to be a rank outsider, independent of the engagement. He can be external or internal. This review has to take place as it progresses, as the engagement progresses. It is compulsory for a listed company audit or listed entity audit. Otherwise, it is not very compulsory. But the SQC advises you to have some quality control review for all the audits that are done by a firm. Within 60 days after the report date, engagement files are to be assembled and kept confidentially. So it is better to assemble it as you do the audit, but probably it will be difficult. Compiling all the engagement files and assembling it and keeping it confidentially, that process is difficult to follow as the engagement is progressing. Therefore, after the engagement is completed, after the reports are signed, within 60 days, you have to assemble everything properly. Because of this understanding in the standards on quality control and the audit standards, the UDIN is also now extended to 60 days. Earlier it was 15 days, then possibly it was made to 30 days, I'm not sure. But the unique documentation identification number, UDIN, has to be taken by the concerned audit firm within 60 days of the signing of the report or date of signature of the document. Because you have time for assembling the file, which is 60 days of time available in the standard itself, to come in line, to go in line with the standard. This is also the international practice. Therefore, UDIN has been UDIN has to be taken within 16 days of the completion of audit. Engagement documentation is property of the firm. It is not property of the client. You should never ever give back all the files that you have created back to the client unless and otherwise there is some compelling reasons under law. Otherwise, you can't give all the engagement files. It is property of the firm concerned and ought to be kept at least 10 years from the date of engagement reports. This 10 years is now changed to 7 years of time. This was earlier. There is an error in this slide. Please change it to 7 years. 7 years from the date of engagement report. Earlier it was 10 years. Somewhere in 2009, they have amended the standards on quality control to understand the engagement documentation cannot be destroyed before 7 years of time. That is what they say. Therefore, it is not 10 years, it is 7 years. Signing partners should be rotated once in 7 years, applies only to audit of listed companies. So if a firm is engaged in the audit of listed entities, which may not really be a scenario in a small firm or small practitioners, there is a requirement of, this is not there under the Companies Act, but this is there under the standards on quality control, where it is said that the engagement partner, the person who is signing the rotation may be once in 10 years or whatever, as stipulated under the Companies Act. But once in 7 years, there has to be rotation of audit partner. But if you are sole proprietor concerned and possibly if you are auditing a listed company, then it is not possible to rotate a partner because it is a sole proprietor concern. Suo motu peer review is suggested in such cases. You can't rotate partner because you are not a partnership firm, you are a sole proprietor concern. Please go in for a peer review on your own volition. Suo motu peer review is suggested in such cases. This is rotation of partners, which is talked of in the standard. It is not there in any law, for example, Companies Act. Monitoring is the final thing. As I told you, this happens after all reporting is done, after signing of the reports. Monitoring is required to ensure that quality controls are relevant, adequate, operating effectively, and complied within practice. After everything is over, you go through the entire process again and understand that whether everything is in order. Periodic evaluation of complete engagement is required. Deficiencies are identified and corrected. So monitoring takes place only after the engagement is over. Otherwise, it is the leadership responsibilities, HR, engagement performance, quality control review, all that is as the engagement progresses. Monitoring takes place after the engagement. Documentation, each element of SQZ, namely leadership responsibility, who is the leader, how exactly formulates policies, ethical requirements, the following of ethical requirements, acceptance of a client, our client is accepted, the integrity, honesty of the client, the risk evaluation, all that, continuation of a client, periodical review as to whether we have to continue the client or not, HR policies, engagement performance, and monitoring. Finally, require documentation. There is no format specified for this documentation of quality control. It can be either a written document or it can be an electronic way of storing the quality control policies, procedures, HR policies, engagement performance, and monitoring. There is no specific format, but it has to be done. There has to be a documentation. This is on quality control, which is more prime, which you have to know even as a small auditor. Maintaining quality is prime, and therefore ensure that to a large extent you read the document, understand everything, try to follow as much as possible, document it as much as possible. Then standards on audit 220, quality control for audit of financial statements. This talks with specific reference to financial statements, whereas SQC is more for all audits. The quality control that has to be maintained for all audits, all engagements. This standard relates to the same SQC sort of a standard, but it relates only to audit of financial statements. Almost everything is repeated here, ethical requirement, leadership qualities, and all that. Independence, I have already told you that every year you have to take from the firm and also from the personnel of the firm a letter stating that they are doing the audit and they have got utter independence, and there is no sort of a relationship with the client. Again, quality control reviewer to be appointed. If it is a listed company, it is compulsory. If it is not a listed company, this is more of an option, but it is better. As a matter of suggestion, they suggest that at least you on a rotation basis have some quality control review for all audits which are unlisted entities. Again, audit report has to be dated only after quality control review. If there is a quality control review in place, for example, for a listed company, it is compulsory. Ensure that the date of audit report is after the quality control review date. Then overall objectives of conduct of audit. Purpose of the audit is to enhance the degree of confidence of intended user. All audit standards are very subjective. It will be more theoretical, but in letter and spirit, you have to read that, understand, and try to follow. It is more of theory. That is why it is not very popular. In fact, 20-25 years back, the topic more that will be more attractive for chartered accountants in a seminar or meeting is only income tax or tax related matters. Then accounting standards was not very popular. Audit standards were not popular at all. Then slowly accounting standards started coming in, and accounting standards became a bit more popular. After advent of larger accounting standards, after advent of the Companies Act giving a recognition for accounting standard and ensuring compliance of accounting standards, the accounting standards are more talked. Now audit is also there in accounting standards in the Companies Act. You have to follow both accounting standards and auditing standards under the Companies Act. Therefore, it is better we learn this, even though they are very theoretical, very subjective. It is better to learn this, understand, and try to follow as much as possible. But largely, you can't flout the standard and do audit at will. One point that I want to tell you here is under SA 200, an audit gives reasonable and not an absolute assurance. No audit, no certificate can give an absolute assurance. To be very precise, you can't give a report stating that it is true and correct. Maybe in future you may have to do that, but as of today, there cannot be an absolute assurance in an audit. It can be either reasonable or limited assurance. In a limited review audit, you do all that. An audit gives reasonable, obviously a high level. Reasonable cannot be a low level of reasonableness. It has to be a high level and not an absolute assurance, which means the audit always carries a risk. There has to be a risk that is not covered. That is why we get into the management responsibilities, auditor responsibility. We say in our opinion and according to the information and explanations given to us, which means there is a bit of risk. We go by what is given to us. We put our skepticism and all that into it and conclude our understanding in the form of an opinion. But even after doing or after taking all the care as to evidences, documenting it and all that, it is not that the risk is fully covered. There is always a risk. To mitigate that risk only, all these standards are there, all these reporting formats are there. While you give a report or a certificate, please go through the standards. There are a lot of draft reports or appendices in each of the standards as to the formation of the report. There is a guidance on the report formation itself, the paragraphs that you have to include, the matters that you have to cover in the report, everything is there. I would advise you just copy paste the format that is given there. There is nothing wrong. We are not copying anything. We are just following mandatorily what is safe for us. Therefore, just copy paste the report. Of course, there may be some changes required here and there to suit your needs, to suit the nature of the report that you give and all that. But do not tamper the format and remove something, add something on your own. All that it is better to avoid. Just copy paste the report, where whatever report that is applicable, maybe SA 700 report or prospective financial information report or a compilation report or a review report, whatever report that you take, please ensure that you copy paste the report perfectly. Of course, subject to some fair changes that you have to make as to the year and all that. Otherwise, don't ever tamper with the report and give your own sort of a sentence or whatever that may lead you into trouble. Therefore, don't please do that. Ensure that you follow rudimentally, rigorously and perfectly the format of the report. Again, to say that audit doesn't give any absolute assurance. Even in tax audit, we can't absolutely assure. For example, TDS details that you mention in Form 3CD, we can do only test check. And we have to put that we have done test check only. There is a report format beyond the Form 3CA or 3CB that you give, which is a report, which is more of a mandate, legal mandate. You can't be refusing to give Form 3CA or 3CB and add something or this something and all that. There is a report suggested by the institute, putting in management responsibility and auditor's responsibility and all that, which you can append, or when you e-file, you can make it as an attachment in PDF along with the balance sheet, P&L and other audit reports under the Companies Act. You can also give this report, which will be supplemental to the Form 3C or 3CB that you submit, to ensure that it is only a reasonable assurance that we give and not an absolute assurance. So this is the fundamental that I want to drive home to all of you. Ensure that you append a report to anything and everything of a engagement that you take. It is as simple as this. What report, what is the format, what exactly you will have to do depends on a case-to-case basis. Definitely for anything that you do, there is a report available in the ICA website, which you can copy, understand, and make some modifications here and there, not very much, and proceed and give it. And this is something that is there in all these standards. Professional skepticism. When you do any audit, have some sort of a pinch of salt understanding, have a doubt in everything, and ensure that unless you get proper evidence, you will not believe the document. Every statement and representation made by the management or the TCWG, what we call as those in charge of governance, those who are given the authority to govern the company, those charged with governance, is to be taken with a pinch of salt. You can't just believe all the documents per se. You must have to have some doubts, and if you have to ask more questions or more documents again, you have to ask for. Till such time you are convinced. But you can't be too very skeptical about things. There is a limit of skepticism. You will not be able to complete the audit. With some sort of risk, you have to complete the audit. That is why an absolute assurance is not given, but a reasonable assurance has to be given. Required to be barking dogs, if not bloodhounds. This is always talked of today. You must have to, now in the NOCLAR, if you have some legal non-compliance in a company, you have to inform the concerned management, concerned persons charged with governance and all that. And if they are not listening to what you are saying, then perhaps you have to inform the legal authority. This NOCLAR even applies to chartered accountants who are working in a company, where if there is a problem in a company, if there is a legal non-compliance, the next level, if you are manager finance, there may be a vice president finance to whom you have to inform the non-compliance. And if nothing is happening, you have to inform the board and all that. And if nothing is happening, even after that, you have to inform to the concerned authority concerned for an income tax violation, legal authority concerned. For a income tax violation, probably the income tax department, or for a GST violation, probably the GST department. So this is the sort of a requirement for the auditors who are practicing and are also employed. Therefore, we have to be barking dogs, if not bloodhounds. That's what I said. See, in all the audits, finally we end up, at least in audit of financial statements, finally we end up saying that the financial statements reflect a true and fair view of the financial position as far as balance sheet is concerned, performance for the year as far as the profit or loss for the year as far as the P&L is concerned, and cash flows of the year as far as cash flows are concerned. Now, if there is any misstatement, if salaries are overstated or understated, if fixed results are overstated or understated, if profits are not clearly determined or losses are not clearly determined, the misstatement arises because of various issues, right from the client acceptance, right from the audit processes, the reviews that happen during the audit process, the quality review that takes place. Anywhere there is always a problem of something that is coming in, which you believe it is right, you end up with a misstatement. Therefore, any work that you do, you must have to have some sort of a skepticism. Unless you are convinced, you can't proceed to the next step. The misstatements in financial statements is the crux of all accounting standards. Any misstatement will lead to so many complications. And if your audit report doesn't take care of those misstatements, then you will be held professionally liable, or there will be a professional misconduct on your part. Therefore, this professional skepticism is extremely important. Again, all these are very subjective. Each audit have to decide how exactly they have to go about it. But the standards excellently guide you to get into some sort of an understanding as to how broadly you have to look at the financials or the entire audit process to ensure that your risk is minimized or your risk is very, very minimum. Agreeing to terms of engagement, the crux of the standard is to have some engagement letter done. The engagement letter can be in the format that is prescribed in the standard, or it can be close to that format. You need not have to copy paste all that. It can vary from client to client, but there is a sort of a format given in the standard itself in Appendix 1, where the engagement letter gives you the objective of the audit, scope of the audit, what is the responsibility of the auditor, what is the responsibility of management, how much is the fee to be charged, when you will bill exactly, the content of the report to be prepared, etc. Everything is given after the appointment is taken from the client. After the appointment, you have to have the appointment letter done firstly, and then give the engagement letter to the client detailing all this. Better you give for all engagements as far as possible, have an engagement letter done, so that you will be saved off an answer later when there is a quality control, when the quality review board of ICAI makes an inspection of your audit quality. Obviously, an engagement letter copy has to be sent by the auditor to the client, and you must have to have an acknowledgement as you collect it back from the client. Documentation, this is obviously very important. Should I answer? There is some question and answer that has come about. Should I answer that now, sir? Appointment letter and management representation letter can be combined. You can't combine, sir. Appointment letter is different. Management representation letter is different. So for smaller entities or for smaller things, don't combine both. Appointment letter is prior to the commencement of audit. Management representation letter is just before the commencement of audit. The management represents various things, what we call as assertions by the management, and that has to be a different process. Therefore, you can't combine. Don't combine. How exactly you will combine, I do not know. No, even though it is completed on a single day, you can't possibly combine both. Have the appointment letter done. Then management representation letter should be taken separately. The factual understanding of everything is done in one day is different, but there has to be a separate appointment letter. There has to be a separate MRL, management representation letter. You can't have both combined in one shot. That looks impossible for me. I'm not sure how we are getting to that sort of an understanding. Certainly. Hope I am clear, sir. Documentation is very important. The discussions that are taking place between you and the entity, how you exactly come to a conclusion, what are all the matters that are discussed and all that. In fact, for CAM companies which are listed, this is one important piece of document that they have to create. It can be in physical form or electronic form. It is to be prepared on a timely basis. Documentation is to be prepared on a timely basis. Again, assembled in 60 days or less, which is also there in SQC, Standards on Quality Control. After the date of audit report. After completion of audit, within 60 days, you have to compile the documentation, and one such documentation is generation of UDIN, which should be done within 16 days of time. The process of taking the appointment letter, management representation are time consuming. I do agree. It will be time consuming. That is where the problem comes for small practitioners. It is time consuming. But if you have some sort of a template, the time taken will be slightly lesser, or you can do it immediately after the assignment. There has to be at least one staff who will take care of all these things. It is difficult. It is difficult for a small practitioner to do all this. That is what I said in the beginning itself. Whatever that is possible, we can't just dispense of everything saying that it is difficult, we can't do. Clear? Everything is for a purpose, everything is for a reason. But if you feel that something is unreasonable, we will have to represent the matter and remove the sort of an unreasonable provisions. I think appointment letter and management representation letters are to safeguard the interest of the auditor. It is better to do it despite the fact that the work is time consuming. But once you start doing it and after having a template, by practice, the time taken will become smaller. You have to start somewhere at the first stage. As you start doing it, it might take some time. It might take some time because you're doing it for the first time. As you progress and as this becomes a habit, it may not consume that much of time as you standardize everything. Even though you're a small practitioner, you can't say that it is impossible, but it is definitely difficult. But you have to tide it over and ensure that you're in compliance to possibly cover your own risk. This appointment letter and engagement letter, you can take, somebody is asking, even for repeated engagement, should we get management representation letter? Appointment letter and possibly the engagement letter, it is not that every year you have to give, but management representation letter is more for representing the matters that have directly impact your audit certification or the regular certificate giving. More of a representation. Suppose, for example, you do a financial statements audit. The various figures in the financial statements are asserted through management representation letter. You are giving a certificate of, say, net worth. The net worth figures are asserted through a management representation letter. Therefore, these two things are different. The management representation letter should be given for each engagement, even if it is repeated. Because obviously the figures could be different. If it is similar figures, the representation letter can be once. So every year, better you take that if, for example, if you understand what we call as impairment, every year it has to be reviewed. So let the management say that they have reviewed and there is no impairment at all. So that sort of an understanding should be there. It is better to get management representation even for repeated engagements year on a year basis. I don't get your SAE number. I do not know what you are talking about. SAE number. I'm not sure about what is SAE number. As regards this engagement letter, somebody is asking whether the engagement letter is to be given each year. Not exactly. Better to give each year, nothing wrong. But it is not compulsory if the engagement terms are the same. And if the appointment continues, for example, 5 years appointment is there, it continues. You need not have to give engagement letter each year if the engagement terms are the same. If engagement terms are to be different, and if you are differing with the terms of engagement, then you have to give an engagement whenever there is a change in terms of engagement. Otherwise, you can give only one engagement, nothing wrong. But management representation letter has to be taken every year. And Gauri Vaidyanathan is asking, should we mention our SAE number? I'm not sure what you are interpreting or what you are understanding as to SAE number. You have to make me clear as to what is SAE number. Okay, I'll take the questions in the end. As somebody puts it, let us take it in the end. Obviously, it enhances the quality of audit. Documentation enhances the quality of audit because as we reach some conclusions, the documentation will help. We may even forget, even though we conclude in a small practitioner scenario, the work would have been done very nicely. I myself is a small practitioner. I do feel this. The problem is with a small practitioner is that the quality of work would be very good. You would have done everything properly. You would have done the audit properly and concluded and formed the opinion also properly. but there will be lack of documentation to understand that if tomorrow some question crops up, some understanding is to be there, we may not be able to prove to the other person that we have done everything rightly. So this documentation helps to ensure that the quality of audit is maintained despite the fact that we have, in fact, I would put it the other way. A documentation could even help a case where the audit is not that very perfect. A documentation, I will stop it here. But nevertheless, if you have done the audit properly, but you don't have any documentation, you might be in a disadvantageous position, even though you are fair enough. Facilitates the effective review and evaluation of audit evidence obtained and conclusions reached before the report is finalized. Documentation prepared after the audit work has been performed is likely to be less accurate. As you progress in the audit, please have the documentation. Then one sort of you are convinced with what is shown as salary in the P&L account, number of employees, this and that. You have verified everything. Have some documentation then immediately and put it in a file to ensure that if you do it later, then you may come across some problem and it is now difficult for you to get back to the report and all that. Therefore, don't do it after the report is done, after the work is performed. Do it parallelly is the advice given in the documentation standard. Fraud, let me not get into most of this. The problem is fraud is an intentional, whereas error is unintentional. A misstatement can arise in a financial statement because of error or fraud. Whenever there is a misstatement, you have a problem. As an auditor, you should discuss with the management and the misstatements are safely removed. If there is an error which is unintentional, the management might change the misstatement. Because it is an error, they may not be even aware of it. Once you point out the error, they may correct it because it is an error. But a fraud is an intentional. Fraud is intentional. Because it is intentional, they will ensure that it is difficult for you to unearth the fraud. It is difficult for you to find out the misstatement, to identify the misstatement, to be very precise. Therefore, you have to be very, very careful because the fraud is intentional. Errors are very common, and errors, if you notice, the management will change. If the management or staff of the company does a fraud, he will do everything to ensure that the fraud is not seen, or the fraud is not noticed, or the fraud is not unearthed. Therefore, you have to be very, very careful. Both results in misstatements. The primary responsibility for the prevention and detection of fraud rests with both charge with governance of the entity and the management. That is why in the management representation itself, you have to be very, very clear about the representations made by the management as to frauds. To some sort of an assertions that there are no fraud by the company, on the company and all that. So you must have to have that done very clearly to ensure that half of the problem is solved. That may not really take you away from the responsibility, but you should be extremely careful to ensure that MRL covers this fraud aspects properly. Auditor is responsible for obtaining a reasonable assurance that the financial statements taken as a whole are free from material misstatements, whether by caused by fraud or error. Fraud is, you have to have more audit process done than an error. There are inherent limitations in an audit leading to unavoidable risk that some material misstatements of the financial statements may not be detected. The standard in the appendices 1 to 3 gives examples of fraud risk, examples of audit procedures to address the assessed risk of material misstatement due to fraud, and examples of circumstances that negate the possibility of fraud. I'm not going to discuss all this here because this SA 240 itself has to be done in a separate seminar. Nevertheless, please go through the accounting standards and how exactly or normal understanding of fraud is given in the appendices. Very scientific frauds, it is always difficult to unearth. This appendices will help you to ensure that there is no misstatement because of fraud. Professional skepticism will ensure that frauds are eliminated. I did tell you that you have to have written representations done in a management representation letter, that management is responsible and all that. The internal controls, the design and implementation and maintenance of internal control to prevent deduct and fraud. They've disclosed to the auditor the results of management assessment of the risk that the financial statement may be materially misstated as a result of fraud. All these are to find a place in MRL. They've disclosed to the auditor their knowledge of any allegations of fraud, suspected fraud, etc. Compliance with the provisions of laws and regulations that determine the reported amounts and disclosures in entities' financial statements is the responsibility of the management with the oversight of those charged with governance. This may change after the NOCLAR provisions, where a bit more responsibility is thrust on the auditors and the employees in the company who are professional accountants to ensure that the non-compliance of laws and regulations are reported either by the working employee chart accountants or by the practicing CAs who certify the accounts of the company to the management, thereafter to the concerned legal authority. This is what I told you, laws and regulations. I'll skip this off. Analytical procedures. These are some audit tools that are available to you, whereby you do some trend analysis, you do some reasonableness of figures that are appearing in the financial statements, work out some ratios. If there is a large difference, that is why we are now we are asked to provide the ratios. And the difference, if the difference is 25% or more, then we have to explain the reasons and all that. That might tell you there could be a material misstatement. If current ratio is substantially different than the last year, is there any figure error, or is there any error in recognition of a receivable or a payable or cash balance or whatever, that will lead you to some sort of a further process of audit to ensure that misstatements are removed. Comparable information for prior periods, anticipated results like budget, similar industry information, consideration of financial information and non-financial information together, payroll expenses to number of employees. These are all some tools that are available under SA 520 that will help you to analyze the figures and come to some sort of a conclusion to further progress in the audit and expand our audit process. Sampling. Without sampling, audit cannot be done. That is why you can't give an absolute. It is not 100% audit that we are doing as of now. It is said that we might have to get into 100% audit later, as the audit field is thrust with a lot of audit tools and blockchain and all that comes. Maybe there has to be a 100% audit, in which case sampling will go off. But as of today, sampling is there, and therefore there can be only a reasonable assurance. We develop a good sample, and the sample results are taken to the population. So 10%, 15% material, based on materiality, we choose a sample size and accordingly sample out the audit. And with that understanding, we presume that the entire financial statements or entire figures, if we check 20-25% of the vouchers and conclude something, then we extend it to the population. The sampling procedures are well explained in this accounting standard, which we can read and understand. But please understand that sampling is the only way out to ensure completion of audit. Related parties, material misstatements could occur more in related party transactions. Inquire into the management to know how related parties are identified and transactions are entered into. Understand the definition of related parties as per AS 18, Ind AS 24, Income Tax Act and Companies Act. And if some transactions which are at arm's length is analyzed in a particular manner, some more deeper analysis has to be made as to price, the quality, so that the related party transactions are not, if there is a related party transaction, possibly there may not even be something of inflow of goods or inflow of cash and all that. There may be an invoice, but no goods would have flown in because both sides are related to each other. This may go unnoticed. Therefore, a transaction could materialize very easily in a related party case in a paper, and physically the transaction would not have taken place at all. Therefore, auditors have to be careful as far as related party transactions are concerned. External evidences should help you to understand related parties. Going concern, this is more talked of. Management of smaller entities may not have prepared a detailed assessment of entities' ability to continue as a going concern. In fact, this is more a debatable topic, whether an auditor can conclude that the company would be a going concern. If historical information available, the last 2 years P&L, the last 2 years balance sheet, transaction that has taken place in the last 2 years, that could give a suspicion of the ability of the concerned entity to continue as a going concern. Well, that is possible. You can form an opinion, but we can't be very futuristic. When you possibly get into future and test the ability of the concerned entity to continue as a going concern, we have to more rely on the management's representations plus the market conditions. Anyhow, we are not experts in understanding of the market. Therefore, if it is futuristic, then there is less responsibility for us. If it is based on historical financial information, there are some issues in the company and the revenue is very much dropping. There are a lot of liabilities and all that. Historically, indications are there that the company may not be a going concern, in which case you would be very, very careful. Of course, you must have to have the knowledge of business and all that. The auditor needs to evaluate management assessment of entity's ability to continue as a going concern. Foreseeable future is 12 months from the reporting date. If you have some confirmation within the 12 months next, the company will continue, then that is enough. It need not be a period beyond 12 months. Assets and liabilities are recorded on the basis the entity will be able to realize its assets, discharge liability, the normal course of business. If not a going concern, all assets are recorded liquidation values. Very simple. You have to ensure that all assets and liabilities, there is no question of depreciation, this and that. In fact, it would be, if you go back to your student days, you would have prepared some statement of affairs to be submitted to the court or some authority when a company, now the NCLT, the liquidation statement of affairs. There we will give the realizable value of assets, we will give the settlement value of liabilities, secured, unsecured, and all that. Then less of all the realizable settlement value of liabilities, then the realizable value of assets, that is net available to the shareholders. So as a contributory, how much a shareholder will get. This is statement of affairs. It is close to statement of affairs. Therefore, everything should be stated at realizable values and settlement values. That is the preparation of accounts, or the framework for preparation of accounts as far as the going concern is concerned. Written representations, we have already talked about it. Most of you might be aware of SA 700 to 720, forming an opinion and reporting on financials, how a qualification is to be made in audit reports, how emphasis of matter has to work. If there is anything that you want to give to the shareholder and bring their attention to a particular matter, even though the matter is in the normal course of business, it's just an information and does not affect the figures of profit or the financial position. There is no qualification required. You can do it in emphasis of the matter. The other thing I want to tell you is there is something that you have to give under other information where if there is any inconsistency between the financials and any other part of the financial report. For example, a board's report might carry some detail which may not be in consonance with the financial statements. They may say sales for the year is this much, profit for the year is this much, and all that. So therefore, there can be so many informations in board's report which could impact financial statement, and if it is corroborative, fine. If the financial statement, the board report say one particular thing in the same manner, then it is all right. But if they are slightly different, if sales reported by the board is slightly different than that what is given in the financial statements, then it's a problem. The auditor has to bring to the attention under other information stating that they are not corroborative. Therefore, ensure that your audit report is finalized after getting the draft of board report or a completed board report. Nothing wrong. Everything can be done parallelly. So after seeing the board's report or notes of financial statements, everything only, you must have to finalize your audit report. Don't do that. Then that is one thing that I want to bring it to your attention as far as other information is concerned. Of course, if you qualify a report, ensure that you give a qualified opinion and a basis for qualified opinion. Also, impact in financial terms as to qualification you have to give. Then if you are giving the internal financial control report over financial reporting, the qualification impact on financial statements also to be given in the internal financial control report also. So if you are giving a qualified report, ensure that your other report on internal financial controls is also drafted, bringing out the lack of effectiveness of internal control as far as the so-called misstatements in the financial statements, which has led to some qualification. In fact, qualified report is talked of under SA 705 as modified opinion report. It is not a unqualified report. It's a qualified report or a modified opinion report. 706 talks of EOM and other matters. I have explained what EOM is. Emphasis of the matter. There is some matter specified elsewhere in the notes on accounts or board's report and all that. You want to bring that to the attention of shareholders, but it can't be a qualification. EOM cannot be a qualification. Then SA 710 comparatives. If comparatives, comparative figures are, for example, if you are appointed as an auditor for the first time in a company, which company's audit is conducted by some other auditor in the previous year, please add in your audit report itself that opening balances are just taken and not audited by you. The earlier year is not audited by you, and therefore the opening balances are not audited by the concerned, audited by us, but by the previous auditor. Ensure that you do that. Then other information I have told you. Other information is any information that possibly have some relevance to financial statements, but not specified in the financial statements. Again, going to SA 700, detailed report formats are there. Please cut and paste that format, but use your brain. Use your brain and make some small changes here and there. But nevertheless, broadly, the format given has to be taken to ensure that you are following the guidance largely by the ICAI. There is one illustration 4 which relates to the format for a non-corporate. This can be used for tax audit reports. This can be used for tax audit report or for attesting the accounts for other purposes like attesting the financials of a non-corporate, whether there is borrowing from banks and financial institutions. So please take illustration 4 and ensure you give an audit report even for some financial statement that you subscribe or sign and submit to bank, or for tax audit reports also. So what I do normally is I prepare a report for tax audit also, call it as Form 3CB, but indicate over there or add over there the management responsibility, auditor's responsibility and all that. In fact, in auditor's tax audit, the management responsibility is to give the information that you see in Form 3CD. The Form 3CD is provided by the management. The particulars to be mentioned in Form 3CD is to be provided by the management itself, which we don't normally do. We do the audit and we fill up the particulars. To be frank with you, to be very straight, we only take the figures relating to Form 3CD, fill up Form 3CD, fill up Form 3CA or 3CB and upload in the income tax website. If you look at it in a very straight, in a very diligent manner, the Form 3CD, I would possibly be happy if the government changes submission of Form 3CD only by the management itself. See, it is the responsibility of the management to provide the particulars to the auditor, like financial statements. Provide the particulars to the auditor. Of course, after we submit Form 3CD, the management approves. The management approves the Form 3CD and the audit report in their login, and it gets complete only at that point of time. So indirectly, the management approves everything. But it would be better if Form 3CD is filled up by the management, submitted in the portal. We go through the Form 3CD from there, agree to whatever that has been given in Form 3CD. And if we have some limitations or qualifications, we will give Form 3C or 3CB with that qualification. Otherwise, we agree and give a clean Form 3C or 3CB along with the tax audit report that I suggest as illustration 4 in SA 700. And we submit only Form 3C or Form 3CB only, which is the audit report, not the Form 3CD. But practically the Form 3CD, for best reasons that everybody knows, it is being done by the auditor himself, and the audit itself is very comprehensive. Now we have to fill up Form 3CD, we have to take particulars, and we have to file Form 3C or 3CB, which is also a report. In fact, it is quite wrong. The management has to give the information to you, and accordingly, you will have to file Form 3C or 3CB only. Just for academic interest, I have told you how far this is practicable, one has to decide. But in my personal opinion, Form 3CD is more for the management than for the auditor. This standard SAE 3400 is quite a standard that will routinely apply to small practitioners. Examination of prospective information. Most of the times in renewal or enhancement of limits of bank, the bank asks for a projected financial statement, namely the projected profit and loss account or the projected balance sheet. And the auditor, let us accept frankly that it is prepared by the auditor and given to the bank. Some banks ask the signature of the auditor. Some auditors do sign. Let us not blame them, but it happens. Is that right? Is the question. Certainly not. In fact, you can't assure a projection. It is not an audit engagement. It is not an assurance engagement. This SAE 3400 comes in handy for you to tell you that how exactly you go about whenever you are a party or you are somebody who is with the management to help them out in preparing a projected financial statement or a projected financials. Most of the times, the small practitioner is asked to certify or attest the prospective information, that is projections. These information relates to transactions and events yet to occur that may or may not occur. The practitioner could give moderate assurance as to the assumptions underlying. This is very important. You can give a moderate assurance. In limited review also, you are giving a moderate assurance or a limited assurance. In a limited assurance, in a normal reasonable assurance, it is a positive assurance. The accounts reflect a true and fair view. In our opinion, the accounts reflect a true and fair view. The balance sheet reflects a true and fair view of financial position. So this is a positive assurance. In a negative assurance or a moderate assurance or a limited assurance, what you say is, nothing has come to our attention that causes us to believe that financials does not reflect true and fair view. See the difference. In a reasonable assurance, you say it reflects a true and fair view. In a negative assurance or a moderate assurance or a limited assurance, you say nothing has come to our attention that causes us to believe that financial statements does not reflect a true and fair view. So it is more of negative words that you say. In our opinion, we don't have any reasons to believe that this statement does not reflect a true and fair view. So we believe that this is more right, but we don't say it in a positive sense. So that helps you to understand that this is not reasonable assurance. We say, naanga paathonga engalukku therinji adula ollu problem irukka mari theriyala. This is how we give. It looks slightly sort of a laughing matter, but yes, if there is a risk, it is a risk and we have to cover the risk. Therefore, the institute has suggested to give only a moderate assurance, not the figure, but the assumption underlying the projections. The assumptions are made like this, the cost of capital is this much, or the discount rate is this much, the sales increase will be this much, 5%, 10%. Clear. The additions towards assets will be this much. So many assumptions are made by the management, which has to be more reasonable, more consistent with what they have done already, and it should be with some basis of accounting correctly taken. So the practitioner could give a moderate assurance as to the assumptions. Please remember, you can give a moderate assurance, that is a limited assurance to the assumptions that are taken by the management and nothing more. The practitioner has to emphasize in his report that actual results may be different than projections and variation may be material. All these are there in the format of that report that you can give along with the projections. Please don't sign the projections at all. This is my personal advice to you. Don't sign the projections at all. Have some report done as per SAI 3400 format. A perfect format is available. You can use with some modulations here and there or modifications here and there. Appendix 1 of SAI gives an illustrative format for a projection assurance, which is moderate assurance. Compilation engagement, I would advise this could be used for sort of a report on provisional balance sheet and provisional P&L account. In a provisional balance sheet and provisional P&L account, which is provisional, you have not done an audit. It may have some material misstatements. The profit may be incorrect. The financial position may be incorrect. Therefore, maybe we can ensure some sort of a presentation and disclosure. Nothing more. But please ensure that you follow the standards on related services, SRS 4410, as to compilation engagements, where you assist the management in preparation and presentation of financial statement or financial information. It is not an assurance engagement, and as it is neither an audit nor a review. Document the discussions with the management, reconciliation with underlying records, copy of final version of the compiled information, and the financial practice report is submitted. Report format is given in the standard itself. There are 2-3 formats that are there in the standard you can give. Please never ever sign a compilation engagement or a provisional balance sheet or a provisional P&L account. Don't sign a projected financial, but have a report done under SAE 3400 or SRS 4410 as to projections or compilation. Accordingly proceed, because small practitioners will normally get into this type of projected financial statements sort of a work or compilation work very frequently. Please ensure that you prepare a report. Along with it, you can also take a UDIN for the report that you have generated. Then this is also very important. Guidance note on reports or certificates for special purposes. Whenever you give a certificate, and when you say certificate, the UDIN site itself will throw you this sort of a alarm or a sort of a warning signal, said that ensure that this guidance note is followed. Because you are giving a certificate, ensure that the UDIN site itself will throw open a box or throw open a window where you will see, please ensure that you follow this guidance note on certificates for special purposes, revised 2016 in letter and spirit. So for this certificate giving also, there are a lot of certificates that you give to TNPCB or net worth certificate, where there is already a format that is provided by the concerned end user. A bank or the government gives you a format and you have to sign in dotted lines. If your report is unmodified, the same format, some figures you give there as the net worth or fixed assets or whatever it is, and just sign, take a UDIN and put the UDIN there in the certificate and sign. This is what we normally do earlier. Now what is required today is, yes, you can give the certificate, because you have to have the format. You can't change the format because it is more legal. They want it in that format, but possibly you can put in the report or certificate itself that this certificate shall be read along with the report that is furnished in accordance with the guidance note of the ICAI as to certificates for special purposes, revised 2016. That sort of a mention you can make so that the user will be aware that there is a report appended to this certificate, which is more in a detailed manner. You have limited your responsibility. You have also brought the management responsibility. The certificate often requires certify, true and correct, which indicate absolute assurance. In absolute assurance, engagement risk is reduced to 0. All these are discussed in the guidance note itself. In an absolute assurance, engagement risk is reduced, which means whatever you say in the certificate is 100% correct. 100% correct. There is no risk at all. Engagement risk is reduced to 0, which means I've seen everything is fine. That can never be done by a chartered accountant. There has to be an element of risk, because after all, you are an external person doing the audit. You go by the facts and figures that is provided by the management. Fraudulently or by mistake, they may not have provided all the details, and you may not have also noticed that detail, but you take exceptions in your report, because as per the information provided and all that, you are mentioning in the report. A practitioner is expected to provide either reasonable assurance or limited assurance. There can't be an absolute assurance. Reports or certificates can provide either reasonable or limited assurance. Don't give absolute assurance. Even though you say true and correct or whatever is the format that is prescribed by the concerned legal authority, you have to give. Please ensure the attached report format is there, very much there in the guidance note. On reports of certificates for special purposes, please ensure that you attach that. Okay, this is regarding that SAE 3400. The report details I have given. Management best estimate assumptions are not unreasonable. This is what you give in projected financials. Prospective financial information is prepared based on such assumptions. The assumptions are not unreasonable. Is properly presented. The prospective financial information is presented. Projections are presented on a consistent basis with historical financials using appropriate accounting principles. The auditor cannot express an opinion. Please understand, you can't express an opinion as to whether the results shown in the prospective financial information will be achieved. You can't guarantee that. Therefore, please don't do any sort of a signature in the projected balance sheet or projected P&L account. The auditor should have sufficient knowledge of business. The auditor cannot vouch the accuracy of projections. The assurance should be negative. That is what I said. Nothing has come to our attention which causes us to believe that assumptions do not provide a reasonable basis for the projection. For a reasonable assurance, you say it is true and fair view and all that, a positive assurance. In a negative assurance, you do it slightly differently. The assurance should also indicate even if the assumptions materialize, actual results could be different than what is projected. All these are very much there in the report format given in SAC 3400. Some extracts from Quality Review Board, very routine procedures are not made and breaches are there. Quality control reviewer is not appointed. Audit documentation is not timely made. Significant matters arising during the audit is not recorded properly. All these are there in the QRB reports. Audit evidence. All these are mentioned in the quality review board. Perhaps in some cases, the quality review found that there is no proper audit evidence that is there in the completed audits. These are all some suggestions made by the QRB Quality Review Board, which is very much there in the standard itself. Wherever there is a non-following, they have given that. This is what is there in QRB. I have been mentioning this. Prepare auditor's report as per the prescribed format. Very important. It's very simple. You are just going to copy paste and you should do it correctly. Don't just take the previous year and do it. Ensure that you have the correct report done. If there is any changes are there, it will be done, and the SA 700 will contain the new format. please ensure that you take the correct format. Disclose the financial impact of the misstatement on basis of qualified opinion per an auditor's report. Some auditors might not have mentioned that. Therefore, they have given this in the quality review board reports. Read the other, that's what I said. Inconsistencies with audited financial statement. There may be some figures which appear both in audited financial statement and somewhere in board's report, somewhere in notes on accounts. The same figure might appear, and if same figure appears with some sort of a difference, or the figures are different in both places, then you have a problem. So ensure that you see everything of the report, annual report, including the board's report, and then issue the audit report. Clear? Having said all this, I leave it to the audience. If there is any doubt, there are few more questions that are there, which I will answer. After which we'll discuss. Small sort of this thing I've prepared, have some engagement appointment letter done, have some engagement letter done. It need not be done on a year-to-year basis. Unless the terms of engagement are changing, you can have the same engagement letter, one engagement letter done and continue. Follow quality control, have management representation done, have all other audit processes done. Please ensure that you have proper documentation. This is what my small checklist, which are prime in audit as far as small auditors are concerned. I thank all of you for a very, very patient hearing. If there is any questions or discussion that can be done, you can corroborate, you can complement my understanding. I will learn from you. Please feel free to ask questions or supplement my ideas or complement my ideas. I will now take up the questions that has come about. But Gauri has asked the SAE number. I do not know what does that mean, SAE number. Should I mention? Yeah, you have definitely mentioned. Wherever there is a standard support to you, you please say that we have followed SRS 4410, SAE 3420, and all that. In the report, the concerned report, this is done in accordance with that SRS 4410 or SAE 3420. Better mention. A fair understanding is better mention. Instead of blindly saying that the report is prepared in accordance with the standards on audit or standards on compilation, like that. Better mention the number itself. Yes, yes. You have to mention the number. In case the financials as a deferred tax asset, should we reduce the same from capital in order to identify whether the company has negative net worth? Should we conclude that going concern could be questioned in case of negative net worth? In case the financials as a deferred tax asset, should we reduce the same from the capital in order to identify whether the company has negative net worth? Should we conclude that going concern be questioned in case of negative net worth? Why should you reduce from the capital? I don't understand. You have to add up the capital, then possibly add up the reserves, reduce something. If the asset values as stated in the balance sheet are different than that of some fair values, which fair value is lesser, you have to reduce. Otherwise, you need not reduce. Why should you reduce deferred tax asset from capital? I don't think it is right. Should we conclude that going concern be questioned in case of negative net worth? You will have a suspicion, because net worth is negative, will the concern be a going concern? If the management assures you that they will revive the company, they will put in more capital, they have asked the creditors to take the money later and all that. If they are capable of introducing additional capital, and if there is a commitment, in fact, if in April or May, before you complete the financial statement, suppose for example, for 31/3/23 you have completed the audit, and or you are in the process of completing the audit for 31/3/23, which is yet to come, and there is a negative net worth or the balance sheet or P&L is very bad, but the management has already put in some money into the company in the form of share capital or borrowed some money with some sort of a commitment and all that, then you can possibly say that because these things have come about, I have reason to believe that this will be a going concern. So you must have some point on hand to ensure that the company will be a going concern. If you have your own doubts because of the past reasons or for the future reasons, then even though the management says it will be a going concern, you can disapprove that understanding and qualify the report. It is more of a position taking by the auditor after considering the management representations in this regard. There can't be a one answer. Just because there is a negative net worth, it is not that the company will not be a going concern. That is my point. Even in compilation, should the accounting policy be disclosed? Yes. In compilation, as an auditor, when you assist in compilation, you must ensure everything, notes on accounts, accounting policy disclosures and all that. Even in a provisional balance sheet or P&L account, an accounting policy, see, all these are management's responsibility. Picking up the accounting policy, following the accounting policy, everything is preparing the balance sheet in accordance with Schedule 3. All that is management responsibility, except for the fact in a provisional balance sheet or in a compilation, the accounts are not audited. Otherwise, the accounts are to be reasonably prepared by taking all the accounting standards and the provisions of company law into account. Therefore, disclosure of accounting policy has to be there even in compilation. Dear Sir, Saravana Prasad B. Dear Sir, there are situations where turnover of non-corporate entities are greater than 1 crore, but still tax audit 3CB, 3CD not applicable due to 44AB limit, non-cash transaction limits, etc. IT return is being filed as non-tax audit case only. However, it seems that as per RBI norms, any borrower has to manually submit UDIN appended audited financial statements if turnover is 1 crore. How to handle such situations? This is more of a management issue. Now, you have to do the audit because the banker wants you to do the audit. Clear? But ensure if you are going to do a presumptive audit, in some cases, presumptive audit may not apply, even though the turnover is less than 1 crore. In some cases, 1 crore or 2 crores. In some cases, presumptive audit will apply. In some cases, presumptive audit may not apply. But if you are doing a presumptive audit and declaring 8% of income, and if you are compelled to do a financial audit, where you are going to prepare a P&L account, balance sheet in substance and form, and also do an audit and sign and give it to the bank because you say the financial statements are required to be audited for some reason or the other, RBI rules, or the banker wants you to give the audited balance sheet and all. Ensure that the profits are at least equal to 8% or less than 8%. Don't give more than 8% there, in which case you will be in trouble under the Income Tax Act. Because just with 8%, you can't escape from the income tax. If the profits are more than 8%, you have to give that figure. Therefore, ensure that the profits are actually 8% of the turnover or less than that. Even under a comprehensive financial audits, profits are smaller than otherwise that you give in the other, because you have not done a tax audit in the ITR4 or whatever you call presumptive tax return. If you are planning to go under that return, if you are not going to go under that return, whatever figures that you give under Income Tax Act, you have to give, because you will be giving a lot of details as to assets and liabilities, income, etc. Because you are not going to adopt that 8%. Then ensure that there is an audit done over there. The same audit is also done here. But if you have adopted 44AD or 44ADA, just because it is applicable to you, but yet you are compelled to do a financial audit, ensure the figures of profit in both the cases, in both the presumptive tax return and also in the regular financial account that you prepare and submit to bank are one and the same. Clear? That's how. The compilation report you can't qualify. in compilation report, you are helping the Gauri Vaidyanathan. In compilation report, you can't qualify. You can't qualify. You can qualify, but that may not really help. That may not really help. Therefore, you ensure that accounting policies are disclosed and the compilation report is given. The compilation report is more of a assurance that everything is right. Nothing has come to your knowledge as to a false statement over there. Therefore, don't take it to that level of qualifying a compilation. Don't do that. Ensure that accounting policies are given in the compilation and accordingly also give a compilation report. That compilation is more a cushion for the concerned user who is going to use that provisional balance sheet or provisional P&L account. Why do you qualify a provisional balance sheet or provisional P&L account in a compilation report? That should be avoided in my personal opinion. But if you look at it technically, there is a possibility that you can qualify. Subject to non-disclosure of accounting policies, the compiled P&L and balance sheet are okay, sort of a report. Again, it is not a regular reasonable assurance, a positive, a negative assurance. Nothing has come to our attention except that non-disclosure of accounting policy. Everything is looking all right and nothing has come to our attention to believe that they are wrong. That's how you have to give. But please don't do this. No, in a compilation, better give accounting policy also and proceed. After all, it may be a 1 or 2 page statement for a small entity. Why do you unnecessarily not do it? Anything else, sir? The organizers have to come and close. If this is to be closed, if there is any questions, I will be happy to answer to the extent of my ability and knowledge. Organizers are there? Let me check up, call them and check up whether they are there. Sir, நீங்க இல்லையோ இல்ல 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 நீங்க அத ஆன்லைன்ல வாங்க, நீங்க have to ask them and அவர் இருந்தாருன்னா அவர் பேசணும், நீங்க பேசணும். I don't think no, அவர் சுந்தரராஜன் இருக்க அவர் தெரியலையே. I'm not sure. கொஞ்சம் பாருங்க நீங்க பாருங்க. The organizers are to come. Sir Matan?
1 minute, sir. Sir.
Yeah.
Sir, thank you, sir. Thank you for accepting the program and conducting. Thank you, sir. Thank you.
Okay. I thank the SIRC and also all the members who attended here for a very, very patient hearing. You can always get in touch with me. The mail ID and phone numbers are there with the SIRC. Or if you can note down, it is 94433433087. 94433433087 is my phone number. BADRI CBE, Badri CBE, Coimbatore @gmail.com. So my phone number and mail IDs I have given. If there is anything, I'll be happy to converse with you. And the discussion, as I already told you, is mutual. I will learn from you, and possibly you will also learn from me. that will augur well for the profession as a whole. I thank you very much for a very, very patient hearing. I thank SIRCOFICAI again for the opportunity.
Thank you, sir. Thank you, sir. Thank you.